From an investor positioning perspective, we actually have seen investors go underweight both Hong Kong and China over the course of the last couple of weeks. So investor positioning is somewhat light. And I think the return of interest, particularly in the China tech space, is something we're going to be talking about for some time. From a JPMorgan perspective, we see this quarter's earnings as really a clearinghouse of expectations. The earnings are coming through basically in line with where we had our forecasts, which is a huge positive relative to where we were for most of last year.
So why the caution in the past 2 weeks?
So for Hong Kong, China overall, it relates more to the fact that we've seen a significant drawdown in overall economic activity. The consumer spend numbers that we got earlier this year were not as strong as expected. And so you are seeing a somewhat narrow rally out of the Hong Kong, China market right now, largely focused around the large tech names.
So the caution from the past 2 weeks is now gone? I mean, is this the beginning of an uptrend, or what's happening?
For China tech, we believe that is true. For the broader Chinese economy, if you look at a lot of the momentum indicators, the reopening trade has clearly peaked from a JPMorgan perspective. You're seeing PPI and overall activity indicators starting to trail off. And we do think we've seen peak momentum out of the economy earlier in the first quarter. So as we look forward, as an example, for second quarter GDP numbers, we just took about 3 percentage points off our second quarter GDP forecast from 6.6 down to 3.6%. So we are seeing a significant slowing, particularly in consumer spending as well as in manufacturing.
So are you saying that the rebound from COVID is not quite as strong as you expected? And how long do you think that might last?
So what's interesting in the underlying macro data is you're seeing a very clear bifurcation. Any industry that is being supported by overall government policy is continuing to outperform. The private sector continues to be extremely weak in both manufacturing as well as in consumption. If I look at overall investment in the Chinese economy, again, investments in overall infrastructure led by the government continues to be strong. Private sector investment continues to be quite weak. So one of the critical things that we're watching right now is the overall status of confidence in the Chinese economy, not overall, but particularly in private industry.
Tell me a little bit more, though, about when you think that's going to change. Because if the private sector and private consumption and all that activity is still lagging, is this going to be a long-term effect?
In the medium term, we do think outperformance out of China will be difficult. We had been overweight China earlier this year. We are taking a more sanguine stance now that the overall activity indicators are starting to trough out.
Okay. You talked about the tech sector. Tell me how you read the current situation. What did you make of the Alibaba numbers? What do you make about the rebound in that space? I mean, the gaming sector seems to be okay.
Gaming sector continues to look very good. And largely that's a function of the fact that you're finally starting to get game approvals again for the first time in a very long period of time. And the overall strength of the platform plays in China continue to be quite strong. From an Alibaba perspective, again, overall consumption trends are not brilliant, and that's showing in the e-commerce numbers as well.
To what extent is any of this affected by all this G7 talk that we've been doing this morning, the policies of the G7 countries towards China?
It's going to be extremely interesting, particularly led by conversations out of the United States. I think the one obvious thing to say is that you have an asymmetry of risks coming out of the U.S. as you go into 2024. The political environment does not reward politicians for making positive statements relative to China, and that is going to be in place for the next 12 to 18 months.
That's a really interesting framing. I like that. I like the way you put that.
And it creates a difficult narrative environment for U.S.-China. What we are seeing, however, behind the scenes is a little bit of watch what we do, not what we say. And what we're seeing is not a significant step up in incremental activity. You are getting a little bit of a tit for tat, and we saw that with the Micron comments out of China earlier. The underlying operating environment, however, we do not see as getting systemically worse. And so I think it's going to be absolutely critical for investors not to watch the headlines, but to watch actual activity in the space.